Great. So still topic number 3. Now we are almost finishing the great topic here. So we are doing subtopic known as key limiting factor. Key limiting factor. Key limiting factor. Key limiting factor. Key limiting factor, we are writing there that this is also known as principal budget factor. Principal budget factor. Full stop. It is a scarce resource. It is a scarce resource. It is a scarce resource. Full stop. Yeah. It is a resource. It is a resource. It is a resource or a condition. It is a resource or a condition that restricts an organization's activities, and therefore limits its ability to achieve objectives, e.g., it can't meet the maximum demand. E.g., it cannot meet the maximum demand. It can't meet the maximum demand. And for us to be able to really exercise on this concept of the principal budget factor, I would want us straight away to look at this question that was tested on August 2023. August 2023, question number 5, boy. August 2023, question number 5, boy. August 2023, question number 5, boy. So once you get the question, are you able to say yes? Why for yes? Why for yes? August 2023, Wanjiku has already gotten it. The name of the question is Rona Enterprise. Rona Enterprise. Rona Enterprise. Rona Enterprise. August 2023, question number 5B. Do you have the question already? Great. So we are told Rona Enterprise manufactures 3 products, namely A, B, and C. The current sales cost and selling prices, details, and the processing time requirements are as follows. The standard selling price, and the standard cost per unit for each product for the period ending 31st August 2023 are as follows. So I can see annual sales for A is 6,000, B is 6,000, C is 1,000. They have given us the selling price, unit costs, then they have given us processing time required per unit. The firm is working at full capacity of 17,000 processing hours per year. You can see in this case here, the maximum capacity is 17,000 processing hours. So there is nothing they can do to increase that capacity. So it means automatically that this processing time is a key factor. It's a key limiting factor. It is a scarce resource. We are told, number 2, that fixed costs are absorbed into unit costs by a charge of 200% of variable cost. Processing can be switched from one product line to another. The selling prices are not to be altered. Information with respect to the maximum demand for each product, which Rona could alternatively outsource from an independent supplier for the same quality, is given below at the current selling prices. So you can see they have given us maximum demand. That demand that you're not able to meet because of scarcity, because of a key limiting factor. And you can see the quoted selling price is given there. Note 6, in the period commencing 1st September 2022 and ending 31st August 2023, the company budgeted for production fixed overheads of 2 million. So they want us to compute the shortfall of the limiting factor. Easy, easy. What shall I do, ladies and gentlemen? I know my products. They are A, B, C. And I know that this shortfall will always come from the resources needed to produce maximum demand. So give me maximum demand column. When I write DD, I know you know it's demand, Maximum demand for A, I can see it is 11,000. For A, it is 11,000. For boy, it is 8,000. For cow, it is 2,000. Yeah. So remember, I'm trying, shortfall will always come from maximum demand and the scarce resource. Scarce resource. Scarce resource. So the scarce resource is processing time. Processing time, which you guys are able to see somewhere. So what is the processing time of A? Is there somebody who is able to see the processing time of A per unit? It's 1. It's on the first table. So this is 1. How about process time of B? It's 1.5. And then for C, it's what here? It is 2. So please give me the maximum. Yeah, give me, in this case here, total processing time. Total processing time. Give me the total processing time. You're multiplying to get those numbers. You're multiplying to get those numbers. So like 11,000 times 1, give me an answer. This is 1 hour. No. 11,000. 11,000. 8,000 times 1.5. 12,000. 12,000. And then we have 2,000 times 2, giving me what figure? 4,000, right? 4,000. So then could you kindly go ahead and give me the total time required? Please go ahead and give me the total time required. 27,000. If you add here, the total time required is 27,000. That is the total time that is needed. Total time which is needed, which in this case I will come and compare with the available time. The available time. Are you able to see the maximum available time? Our full capacity, 17,000. This has been given in note number 1. In note number 1, 17,000. This has been given in note number 1. So ladies and gentlemen, of course you can see, it's just like how you can go to a supermarket with your kids, and then of course you take so many goods, in that trolley, you push forward these goods, in this case here, to the cashier, and then the cashier now tells you that, hey, you know what? You need 27,000. Yeah, that's what you need. But what you have in this case is how much? You'll be forced to return some things, isn't it? Yeah. But depending on your social capital, if you don't have very good social capital, people can call here and there, and then they send you, then automatically you'll be forced in this case here to return the goods. So then what is the shortfall? To get the shortfall, you look at the time needed vis-a-vis the available time. You subtract. So in this case here, this gives us what here, somebody? 10,000. So this is the shortfall. The shortfall. So the shortfall there is 10,000. That is what they wanted you to do in part 1 of this question. They wanted you to compute the shortfall of the limiting factor, something that you've been able to do very, very well. So can I go to number 2? The online guys, can I go to Roman 2? The online ninjas, can I go to Roman 2? Thank you very much. So in Roman 2, they want me to determine the optimal production mix, indicating the products and the quantity to outsource from external supplier. So they want us to give them the optimal production mix in light of a key limiting factor. In light of a key limiting factor. So they want me to give them optimal production mix, optimal production mix in light of a key limiting factor. So remember the basic steps. Number 1, you give RCM. That is the first step. Number two, you give us the scarce resource units, yeah, for each product. And then number three, you give us CM per unit of scarce resource. So in short, you take this divided by this, you divide those two, And then number four, you will come and do what here, somebody you rank. Yeah, on the basis of this, the higher the better. And then number five, ladies and gentlemen, you shall come here and give us the optimal, yeah, production mix. The optimal production mix. Yeah, so we start in this case here with our products here. We start with our products, ladies and gentlemen. Let's start with our products. So the products that you have, I hope you are able to see them. The products that we have, I hope you are able to see them. So we have here products A, B, C, A, B, C. So I want you to calculate for me the contribution margin in a minute. Please compute for me the contribution in a minute. Already they have all of them. They are saying that you see the contribution margin. Anytime they want us to get contribution margin, it is price minus what here, somebody? Variable cost. It's price minus variable cost. So, ladies and gentlemen, in this case here, we have the selling prices, and here there was confusion, which was brought by the examiner. Yeah, the selling price given there is a standard, which is what there. So we have price, selling price. Selling price. In this case here, this should be what here, somebody 200, 200. 320. I'll explain about this other price. It was quite a mistake on the examiner side. 400. Are you able to see, ladies and gentlemen, in this case here, the variable cost? Variable cost. Oui. Note number 2, fixed costs are absorbed into unit cost by a charge of 200% of variable cost. Wanjiko is talking of 180 question mark there. Let me give you some minutes here. You try this. I want you to give me, in this case here, this variable cost. A is 140. They're saying A is 140. B is 320. No. B is 240. C is 300. Variable costs. So remember, fixed costs are absorbed into unit costs by a charge of 200% of variable cost. So meaning that our unit cost, my friends, of course, unit cost will be equal to unit variable cost plus what, yes, somebody? Plus fixed costs. Yeah, so in this particular case, our unit cost will be equal to variable cost, and we know how they're calculating their fixed cost. How are they calculating fixed cost? It is 200% of variable cost. So basically double of variable cost. So meaning that the fixed cost will be 2 VC. 2 VC. So we start with product A. So product A, are you able to see the unit cost of product A? It is 180, isn't it? So then 180 will be equal to, of course, this will be 3 VC, 3 VC, 3 VC, 3 VC, all right? Meaning that variable cost alone, ladies and gentlemen, will be 180 over what here, somebody? Over 3. 180 over 3. 180 over 3, which gives us what here, somebody? Which gives us 60, which gives us 60 like that. Is it something that you guys would have thought about in an exam? It's quite tough, eh? That's advanced management accounting for you. Yeah, we shall overcome. You see, anytime you want to get this total cost, it will be cost per unit or total cost. We normally take variable cost plus fixed cost. And then they have told you the way they're absorbing the variable cost, the way they're absorbing the fixed cost. That fixed cost is 200%. You see, 200% is the same as 2. 200 divided by 100 is the same as 2. So 2, in this case here, of the variable cost like that. Now, using the same concept, then are you able to give me the variable cost in this case here of boy? Variable cost of boy. Somebody who can give me the variable cost of boy? Using the same concept. Yeah. How much? 80. 80. How about this giving us 300 divided by 3? 100, right? 100. Let me repeat here how we got this fixed cost. That is a student asking how we got the fixed cost. I like such students who ask questions before we rub. Those are good students. So we have here unit cost. We are told that unit cost, how do we get this unit cost? Look at note number 2. Fixed costs are absorbed. They're absorbed into unit cost by a charge of 200% of variable cost. So meaning that ordinarily, we know that any total costs for these units will always be variable cost plus what here, somebody? Plus fixed cost. So they have told me that to get fixed cost, they take 200% of variable cost. And 200% of variable cost, this is the same as 2 variable cost. So meaning that anytime they want us to get unit cost, it will be VC plus 2 what here, somebody? Plus 2 VC. So now instead of the fixed cost, like that. So we take the way of absorption. So then this will be unit cost. Unit cost equals 3 what here, somebody? Meaning that VC will be unit cost divided by what here, somebody? Divided by 3. So meaning that for product A, ladies and gentlemen, we took the unit cost of A. Unit cost of A is 180 from the table given. We divided this by 3. For boy, we took the unit cost of boy, 240, we divided by 3. For cow, we took 300 divided by 3. That's what we did to get these numbers, and I hope now that is okay. So then go ahead and give me the contribution margin. Go ahead and give me the contribution margin. Great, cheers, yeah. So 200 minus 60 gives me 140, 320 minus 80 gives me 240, yeah. Then we have 400 minus 100 giving me 300. Now, ladies and gentlemen, once you write up to there, what should be the next step? The scarce resources for each product. Scarce resources for each product. So give us the processing time. Processing time. Yeah, which is our scarce resource for each product. Are you able to see the scarce resource for our products processing time? Oh, yes. I can see 1. I can see 1.5. I can see 2. So if we are together, what do you think will be the next step after writing down the processing time? We divide, right? We divide because now you can see number 3. They want us to give them CM per scarce resource. So come and write here, CM per scarce resource. So 140 divided by 1, isn't it? They are not talking to me. I will overcome. Fortunately, it's only for 3 hours. 3 hours, and then I overcome. 140 divided by 1 is 140, isn't it? Yeah. 240 divided by 1.5? 160, yeah? So this gives me 160. And then we have 300 divided by 2. 150. 150. After that, ladies and gentlemen, now we shall do the most honorable thing, which is to do what? To rank the products. Remember, the higher the CM per scarce resource, the more profitable, the better the product is. So get ahead and rank. Don't rank from the last. The very best in this case here is product what? Here, somebody, boy. So this takes up number 1. This takes up number what? Here, somebody. Number 2. This takes up number what? Here, somebody. Number 3. Thank you so much. So now we have our ranks done here very well. Now you can go straight away to number 5 that we call the optimal production what here? Mix. Optimal production mix. That we must give it always its separate table. You must give it always its separate table. The online ninjas, I know some of you could be in a place with network issues, but so far, are you able to follow? Ama mnaona vimulimuli. Wanafuata. Thank you so much. Wanafuata. 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 So then for the optimal production mix, come here, ladies and gentlemen, and the givers, 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 the optimal production mix. So give us the products here as ranked. The products as ranked. As ranked. So in this case here, they want to take top position will be product B. So this takes position number 1, B. After that, we go to what here, somebody? C. After that, we go to what here, somebody? A. Yeah. So give us the maximum demand. Give us the maximum demand. Maximum demand for boy. Maximum demand for boy. Go to that table where they have given us maximum demands and read for us the maximum demand for boy. The maximum demand for boy. Maximum demand for boy. What do we have there, somebody? 8,000, isn't it? So we have here 8,000. 8,000. And then we have cow. Cow is what here, somebody? 2,000. 2,000. And then we have A. 11,000. Yeah. So give us the scarce resource, the processing time for each product. Processing time for each product. For boy, don't mix there. Don't mix issues. For boy is 1. Are you sure? They are given here. So 1.5, isn't it? And then for cow now is 2, isn't it? Cow is 2. And then for R is what here, somebody? 1. So remember, this is per unit, per unit. So in this case here, total processing time, we multiply, isn't it? We multiply. So we take this times that. So then that will be able to give us the total processing time. So 8,000 times 1.5, 12,000. I'm alone. 12,000. 2,000 times 2, Mwalimu, stop also being lazy. That one you can see, yes. So this is 4,000. And this one is 11,000, isn't it? So come and give me the total here. 27,000, isn't it? 27,000. 27,000. So this is total required. Total required. And the total available. Do you remember total available was 17? Total available was 17,000, isn't it? Total available was 17,000, like that. So the shortfall. So the shortfall. 10,000, isn't it? Yeah, shortfall is 10,000. So of course we are done this shortfall thing from up there, Roman 1, but you can't tell the examiner refer above. That's bad language. You can't tell the examiner to refer above, eh? So now we have the shortfall. Now, ladies and gentlemen, just to go back to that analogy of where Mwalimu has gone to a supermarket with his 3 kids. Yeah, they have taken everything from the shelves, put them on the trolley. Mwalimu is basically pushing them, goes in this case here to this teller. The teller tells Mwalimu, it is 27,000 you need. And left, right, north, south. The total money that I have is what here, somebody? 17,000. So what does it mean? I must return some goods back. And the goods which I'll return back will be the goods in this case here, which are of least priority. Least priority. So if there is a young kid who has taken a sweet, those ones we return regardless of how much, how they cry. Those ones, so least priority. So which one is a product of least priority here? It is A. So we snatch hours from it. And unfortunately, these shortfall hours are able to be absorbed by all this. Yeah. So in this case, I will simply come and say minus what here, somebody? Yeah, fortunately, yes. Minus 10,000. So 11 minus 10,000, that gives me what figure, somebody here? That gives me 1,000. I want to make this a fun class. What if in this case, ladies and gentlemen, what if in this case, I want to get your ideas from this. What if, ladies and gentlemen, this was 16,000? Thank you so much. What if this was 16,000? Shortfall. Can you kindly help me recover those hours upwards? If there was 16,000, let me see somebody. You can even write somewhere, like you see, like I have a place I can write here, just rough work, eh? Yeah, and you are saying, what if the shortfall? What if the shortfall was 16,000? And then you have in this case here your products here B, C, A. You have in this case here processing time. This is 12,000. This is 4,000. This is 11,000. So I want to see recovery of this shortfall from these units here. I want to see how you shall recover. I want to see how you shall recover. So please talk to your neighbor. I like what I'm seeing these brothers doing. And we have a new guest here. Yeah, karibu sana. Yeah. We first deduct from. We start from the least priority. Yeah, least lucrative. So the least lucrative has 11,000. So of course I want more than 11. So first of all, I'm being told, Mwalimu, eat all those. So once I take the 11,000 from this, now what do I have? Now, ladies and gentlemen, I happen to be having 0 here, fine, but I haven't recovered all of them. I still have some more to go. How many do I have to recover still? You see, I had 16,000 to recover. I've recovered 11. So the balance is 5. So 5, so I move up. So I move up. So like in that case, I come and recover how many here? 4,000 here. I haven't yet recovered fully 16. I still have what here? 1. So I keep on going up like that. So here, so in this case here, basically, I will be having here 11,000. Here I'll be having 0. Here I'll be having what here, somebody? 0 like that. So be very careful how you do that recovery. Yeah. So here we had a shortfall of 10,000. And this 10,000, all of it would easily fit into this 11,000. So we deduct just that, and the shortfall has been recovered fully. Great. And then again, you come and give us here, second last title, processing time per unit. The same one here, processing time per unit. Processing time per unit. This one, of course, is 1.5. Same to this is 1, like that. So then, ladies and gentlemen, you'll be able to come and give us the optimal mix now. The optimal mix in terms of units. In terms of units. Optimal mix in terms of units. So optimal mix in terms of units. Remember, we have the processing time for all the units. And we have processing time per what here? Somebody per unit. Yeah. So 1 unit, 1.5. What of this hour? So basically here, to get the optimal, we divide this. We divide. So the optimal mix, like the first one, will be 12,000 divided by 1.5, which will be exactly 8,000 there. Because here we haven't snatched any resources. For product B, we never snatched any resources. Yeah, we are going to meet the maximum demand because that is our aim. Our aim is to meet the maximum demand. All right. So 12,000 divided by 1.5 gives us how many units? We are dividing here. So remember, from here, we multiply. But now moving to optimal mix, we divide always. So this is 8,000. The second one will be what here, somebody? 2,000. But now remember the last one, we don't work with 11,000. We are working with how many hours now? 1,000. So 1,000 divided by 1 gives us what here, somebody? 1,000. And that is the end of that question, the optimal mix in terms of what here? Units. So you'll simply, ladies and gentlemen, in this case here, just get used to this table. The moment you get used to this table, that will be it. You will really be very good at this. So then remember, we don't want to miss anything. After you have told us what you shall produce inside here, they also told us in this case here to go ahead and tell them what we shall outsource. Whatever demand we're not able to meet by our own production, we shall go outside there and outsource. So that is normally very easy. So come and create the last column here, outsource. So ladies and gentlemen, you can see the demand here is 8,000, but you have produced how many? 8,000. So in this case here, we are not outsourcing anything here. Actually, we should have written, sorry for that. We should have written here optimal production mix to avoid any confusion. This is optimal production mix. So you can see the demand here is 8,000 and you have produced 8,000. We have fully covered what these particular customers of ours need. The same case with C. We are fully covered. But when you look at A, they needed 11,000 and ourselves we are producing how many? 1,000. So how many do we outsource? 10,000, isn't it? Yeah, so please take a screenshot. Take a screenshot. Take a screenshot, especially, but even if you miss, because I've marked these papers for so long, very few students will be able to create that column of outsourcing correctly. Very few. So if you're able to get up to optimal production mix, I'm really happy. I'm really happy. So there is a student who wanted to screenshot. I will give you a minute. Once you finish, would you kindly say Kidole Sambusa? Great. Great. So this is a question that I would want you to go and redo it at your own time. And ensure that you redo this. If I were an examiner this semester, I would ensure I put this kind of a question of key limiting factor in your exam. Fortunately, I'm not. So we shall overcome. Now, ladies and gentlemen, I explained the outsourcing. So remember, thanks for asking. What have they told us there? Look at note number 5. Note number 5. So note number 5, they are telling us information in respect to the maximum demand for each product, which Rona enterprise could alternatively outsource, from an independent supplier for the same quality is given below. So what does that mean? That if you're not able to produce these goods internally, we shall always buy them from an independent supplier. So you can see our demanded units here. Like for boy, it is 8,000 units. And our sales in this case here from our optimal production mix, we know we are going to produce 8,000. So you see the demand and what you're producing is matching. So you don't want anything from anybody outside there, 0. Second product, we have demanded to produce 2,000 and we exactly produce 2,000, 0. Here now, the demand is 11,000, but we have produced 1,000. So the difference is what we outsource. The difference. You can even say outsourced column is this column minus the optimal mix column. Actually, that is the best. That is the best thing about asking these questions. We are learning, even myself, I'm learning, that to get outsourced, we shall take the maximum demand minus optimal. Yeah, great. Minus optimal. Maximum demand minus optimal. It shall never be negative, of course. Maximum demand minus optimal. All right. Now, with your permission, I will be able to go to the next question, which is Roman 3, where, based on your recommendations in B2 above, determine the net profit for the period 31st to August 2023. So are we ready for the second part? For this last part, I mean? Are we ready for the last part? 3. Yeah, thank you so much. So give us their profit statement. Profit statement. Profit statement. So profit statement. So we have our 3 products. So it was B, C, and A. Yeah. And remember, we are using the concept of what here? Profit equals, not revenue, but CMX, right? CMX minus fixed costs. Minus fixed costs. Yeah, so it's BCA. And if you are very, very bright, if God will be able to open those inside eyes for you, which I really pray that he does. We have in this case here section for outsourced. So remember, we outsourced A. We outsourced some units of A. We outsourced some units of A. Yeah. So remember already, we have actually most of these things. We have price, we have variable cost. So ladies and gentlemen, what is the selling price for A? The selling price for A, not A, B, sorry, B. Selling price for B is how many units here, somebody? Not how many units, but how much? 320, yeah? 320, C? 400, right? 400, right? A is 200, isn't it? So of course, even the ones that you have outsourced for A, when it comes to selling, you'll sell at the same 200. You'll sell at the same 200. You'll sell at the same 200. Because we have even been told that the quality is the same. Then come here and give me variable cost. You great ladies and gentlemen had given me the variable cost of this product. You had given me the variable cost of this product. So A, not A, but B, boy. Boy was 80. How about cow? 100, 100. How about A? 60, How about the variable cost of the outsourced product A? 60 the same, but you're not producing them internally. Remember this variable production cost. We are buying them, isn't it? So the buying price becomes the variable cost. And that is where the examiner went slightly wrong. He should have mentioned there, quoted buying price. So that students in this case here would have confused this price with the selling price. So this one here should have been quoted buying price. And the quoted buying price for product A is how much, ladies and gentlemen, here? The quoted buying price. Remember, you're talking of A. We are going to buy this at 175. It's going to be costly. So the contribution there will be very little for us. But I mean, do we have a choice? We simply want to meet demand. If we don't meet demand, then somebody else, a competitor, is going to do that. And now remember, buying price is always a variable cost. Yeah. So get ahead. And in this case here, subtract like that. And then you give me what we call contribution margin. You give me contribution margin. Give me contribution margin for each one of them. Remember, contribution margin is price minus variable cost. This is price minus variable cost. So 320 minus 80 gives me how much? 240. Thank you so much. 400 minus 100 gives me how much? 300. Thank you so much. This gives me 140. This is a miserable 25. So please give me the quantities from your optimal production mix. Are you able to remind Mwalimu what the quantities were for boy, for cow, and for R? From the optimal production mix column that I rubbed there, we said, boy, you're going to produce how many? 8,000. 8,000. How about cow? Production, the production quantities, 2,000. 2,000. How about A? And how many of A are we going to outsource? 10,000. For A, we're going to outsource 10,000. So please go ahead and give me the total contributions. Total contributions. Give me the total contributions. Give me the total contributions. Give me the total contributions. So like you're multiplying, isn't it? CMX. CMX. So 240 times 8,000. What figure are we getting, my good students? 18? 1920. The year that I was born. Yeah. 1920,000. Yeah. How about 300 times 2,000? 600,000. Thank you so much. 140 times 1,000. That's 140,000. All right. And then we have 25 times 10,000, giving me 200 what here, somebody? 50,000. So give me the grand total. Give me the grand total. Give me the grand total. We're adding up everything, isn't it? We're adding up everything. Give me the grand total. Please give me the grand total. Give me the grand total. So munasema ati ni ngapi? 2910. 10,000. And then of course now from the grand total, you shall come and less what here? Fixed costs. Because fixed costs, we do not want to, ladies and gentlemen, in this case here to put for each product, because they are common, right? They are common. So the fixed cost, which they have told us to work with in note number 6, is a fixed cost of how much? 2 million. Is a fixed cost of 2 million. A fixed cost of 2 million. So should you subtract, what are we able to get here, ladies and gentlemen? This is your net profit after doing all that work. We have a net profit of how much? 900 what here? 10,000. Ladies and gentlemen, I'm not training students who will be perfect. No. Perfectionism is very, very costly. Yeah. What I would, of course I know, most of us in this case here would not have gotten this right. Yeah. But you see, we normally mark in this case here entries. I'll share a marking scheme with you. We normally mark entries one at a time. And you'll be surprised, your final answer may not be correct, but with the right entries, many of them, you will end up in this case here getting all the marks. Is that okay? Yeah. Yeah. Where do we use the annual? sales. Where do you use the annual sales? Remember again, in management accounting, ladies and gentlemen, you don't have in this case here to use all the information. No, because you see annual sales, that could be for the previous year. And as in this case here, we are looking at a prediction, future. That is why you can even see in terms of fixed cost, we've used in this case here our what year? We've used in this case here budgeted production. So you're looking at the future. That's why you can see they're talking of expected maximum demand, looking at the future. So there are things that you use, there are things you cannot use. Is that okay? Yeah. All right. So then I will be able to give you a few minutes so that you also get to attempt one question, isn't it? You shall also attempt a question, right? You shall also attempt a question. We can't just do without you guys attempting questions. We shall attempt questions. We shall attempt questions. So we look at December 2024. December 2024, question number 2, cow. Sorry, Maslin. December 2024. December 2024, question number 2, cow. December 2024, question number 2, cow. And I'm giving you exactly 15 minutes. Try to get somebody, even if you're at home. If you're at home, try to get somebody to discuss with. Yeah. They don't have to be accountants. You can use your kids. Teach them. Teach them. What did you use? 175 as the variable cost. Good question. Remember, assuming in this case here, I'm selling clothes. Yeah. And the selling price for each piece of cloth is 1,000. And my buying price for each piece of cloth is, for example, 600. You see, when it comes to buying price, you are in retail business, you're buying and selling. The buying price becomes automatically your variable cost. The buying price automatically becomes your variable cost. So these outsourced items, I'm going to sell each one of them at the common price of 200. But remember, I bought them. I outsourced them. Outsourcing means buying. I bought them. These units of, if you look at the buying price, which you corrected a little bit there, it's 175. And that buying price of 175 will be purely variable, because the more the units you buy, the more the buying price will be. The more the buying price will be. So December 2024, question number 2C. That one is given in the notes. Note number 6, 2 million muslin is given. Fixed cost is given in the notes. Fixed cost is given in the notes. So we are doing December 2024, question number 2C, and the Mwalimu is giving you exactly 15 minutes. We see how you would have rolled with the ball. Let's see how you would have rolled with the ball. Let's see how you would have rolled with the ball. Let's see how you would have rolled with the ball. December 2024. This question is titled Skyview Technologies, isn't it? Skyview Technologies. Just Roman 1. I don't want you to do the transfer pricing. I just want you to look at Roman 1. Roman 1. Roman 1. Everything I've been able to explain to you. What, ladies and gentlemen, in this case here is disturbing these people is labor, not 3. Total labor hours in the current period for motherboard are limited to 56,000 labor hours. Imagine I will not take, because I can see you online there, reading the question forever. I can't read this question forever. I don't have to get everything. What I need to do, ladies and gentlemen, straight away is to be proactive. The moment I realize that this is a question of a limiting factor, I remember those steps. Contribution margin. What is scarce for each unit? Divide, rank. Run with the ball. Be a good football player. A good football player, you don't see obstacles. The obstacles you should be able to, move like this until you overcome. Until you overcome. Until you overcome. So I'll come back at exactly 10 10.25. 10.25, and then we compare notes. Nobody should run. Of course, I know the online students, you may be tempted to disappear once I give you an assignment. This is what will put everything now in our mind very well, because this question, as you'll realize, it doesn't have any scarcity. You'll be able to see that the hours you need will be less than what is available. So there is nothing tricky in this question, nothing like outsourcing. It's a very, very easy question. Very easy. Very easy. Very easy. Let me give you those 15 minutes, and then we see how you're rolling with this ball. So remember, it's only part one, because transfer pricing is in the next chapter. There is a whole chapter called the pricing. So I'll not do transfer pricing. I'm only doing the limiting concept. So you're told Skyview Technologies Limited has two divisions, motherboard division and a smart TV division. Motherboard division is a profit center which manufactures three intermediate components that are used to make smart televisions. The three components are U, S, and B. Each component has an external market, but also transfers to smart TV division. Pertinent data about the three components is as follows. So you can see the external market price. You can see the unit variable production cost in motherboard division. You can see the fixed production cost per unit. You can see the labor hours required. And then you can see maximum OTR, external sales demand. Motherboard division has received a special order to transfer 3,000 units. I won't even read that. 2, instead of receiving transfers of component S from motherboard division, smart TV division could outsource similar components in the open market at a highly cheaper price of 2,200, just like the other question. The total labor hours in the current period for motherboard division are 56,000. Motherboard division transfers the special order at a marginal cost plus opportunity cost. Divisional managers are autonomous and will sacrifice the component that has the lowest priority ranking. So they want us to give them the optimum production mix units under the limiting factor analysis. So we start right away with our products. So there are three, U, S, B. Yeah, so give me the selling price. So are you able to see the selling prices? U is 2,400, isn't it? S is 2,300. B is 2,000. Then we have, in this case here, variable. This was a graciously good examiner. We have variable cost per unit. He never gave us those things of 200%. No, nothing. So in this case here, we have a variable cost 1,650, 1,200, 1,400, isn't it? So please subtract these to get what we call contribution margin. So our contribution margin, according to Edwin, 750. The second one, 1,200, 1,100, 600. So from here, what should be the next thing to be done? The limiting factor, the scarce resource, isn't it? Let me call it limiting factor. Limiting factor for each product. Limiting factor has been given in note number 3, labor hours. Note number 3, labor hours. And labor hours for each is 342. So we have 342, like that. So then come and give us the M per what here, somebody? Per limiting factor, isn't it? Or per scarce resource. So 750 divided by 3 gave you guys what figure? 250. 1,100 divided by 4 gave you guys what figure? 275. Then lastly, what do we have here, somebody? Were you able to do rankings yourselves? Yeah, very easy, easy peasy. So rankings, this takes up number 1. This takes up number 2. This takes up number 3. Then you should be able to go ahead and give us the optimal production mix. So optimal production schedule. Optimal production schedule. So optimal production schedule, you give us the products as per the ranks. Give us the products as per the ranks. As per the ranks. So as per the ranks, what do we have, my good students? we have product B. Yeah, as per ranks, as per ranks. So we have B, after B we have S, after S we have U. So come and give us the external maximum demand, maximum DD. Maximum DD for boy. Are you able to see for boy maximum DD is 3,000? William alone. 3,000. S, 5,000. U, 8,000. So then come and give me the labor hours. Labor hours, which are scarce, isn't it? Per unit. Don't get confused here. Remember, this is not your first product. You have to be very careful. So B, it is 2. S is 4. And then here we have got what here, somebody? 3. So remember, these are labor hours per unit. Go ahead and multiply them for you to give us what we call total hours. So the first one will be 6,000, isn't it? 6,000, 20,000, and then 24,000. So when you add, what do you get, somebody here? 50,000, isn't it? So this is what is required. I told you this. Available is how many? 56,000. So in this case, ladies and gentlemen, there is no shortfall. No shortfall. Shortfall. Usiweke negative. Shortfall is 0. Because you can see in this case here that our maximum, our what is available, will be able to cover, the required. We'll be able to cover the required. We'll be able to cover the required. We'll be able to cover the required. So this special order will come later. Will come later when you do those things of transfer pricing. Because remember, special order is not among the units in this case here that we are forced. So that one will come later. Remember, for limiting factor, we use the maximum demand. Maximum demand. Maximum demand. So in that case here, then the optimal mix, you don't even have to bring, the optimal mix here, because we are able to get all the hours. So in this case here, B, we produce what has been demanded, isn't it? So 3,000. We have here what here, 5,000. Here we have what here, somebody? 8,000. If you wish, you can still come and put labor hours in between. So remember, these were 2, 4, 3, and then you divide. If you wish, you divide. You get the same answers. You get the same answers. You get the same answers. So we'll be able to do the full question, and we'll be able to see how we bring this concept of what here, special orders, into our analysis. Otherwise, for now, give me another title: simulation of CVP. Simulation of CVP problems. Simulation So we're almost now finishing this chapter, simulation of CVP problems. So to simulate is to imitate. Anytime you hear about simulation, we are imitating reality. So to simulate is to imitate. And for you, what you are required to basically appreciate is how do we generate random number ranges? How do we get random number ranges? And then you are done. Fortunately, I'm teaching this after you guys have done it in advanced financial management. December 2022. Yes. 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 You see, we have a topic called transfer pricing, which is ahead of us. So you shall be able to finish the whole question when we do that. Otherwise, if I do it now, you'll hate the topic because you don't have the, you don't have the grounding. You'll hate the topic, which will be very bad. And it's always a must come. Transfer pricing is a must come. So then we move straight away to December 2022, question number 2A. December 2022, December 2022, question number 2A. December 2022, question number 2A. Once you get it, please put your thumbs up like this. To simulate is to imitate. If, for example, today you are to go to a good driving school, there is no way they will take you to the road physically with a real vehicle. First of all, they will give you a toy. So they're simulating reality. The same case with the aircrafts, the same case with the doctors, etc. Yeah, if I come in this case here to your hospital and then you tell me that, hey, let's go to the theater, and then I look at you, you are 22 years old. I'll tell you, no, go and play around with kidneys of dogs, rats, actually dead ones first. Yeah, and then when you're doing that, you're simulating. So December 2022, question number 2A, what have they told us there? So you're told Lengo Limited is considering marketing a new product. The fixed cost of this product will amount to 5 million. There are 3 uncertain factors: selling price, variable cost, and annual sales volume. The product has a life cycle of only 1 year, and the various possible levels of these factors together with estimated probabilities are given below. So you can see the selling price, you can see the probability, variable cost, probability, annual sales volume, probability. Then additional information, assume that the 3 factors are statistically independent. Number 2, the company uses CVP analysis to make what year decisions. Number 3, the following random numbers are provided. So using CVP analysis criteria, simulate the problem and determine the average what year profits. Determine the average profits. So here I will be able to get all the marks without even knowing what is happening. So we start with the assignment of random number ranges. Assignment of random number ranges. Assignment of random number ranges. There are basically 2 basic steps here. Assignment of random number ranges and a simulation worksheet. So we start with this and we shall attack one variable at a time. We start with selling price. So the selling price, we have 400, 450, and then the next one is what here, somebody's selling price? 500, yes, 500. So are you able to see the probabilities? Oh, yeah. Probabilities, we have them 0.3, 0. And then lastly, we have 0.2. So then get ahead and give us cumulative, because that is the next step under simulation. Go ahead and give us cumulative probabilities. That means summing down. You are summing. So cumulative probabilities, you can write this in a full. Cumulative probabilities. Yeah. So you're adding downwards. So this is 0.3. This will be 0.8. This will be 1.0. Now from there, you can give us what we call random number ranges. Give us the random number ranges. Now remember that random number ranges, they normally fall in between there. Yeah. So remember, this is for 1 decimal place. 1 decimal place, it will be 0 to 9. And then, of course, we have like, if there are 2 decimal, you see like this 1 decimal place, it will be single digits. If there are 2 decimal places, 0, 0 to what here, somebody? 99. If there are 3, the same. So these are single decimal places. See how I'm going to come up with my classes. See how I'm going to come up with my random number ranges. So like the first one will start from 0 all the way. I will read this as if it's a whole number, 3. And then to get the upper limit, I take this number minus 1. So 3 minus 1 gives me 2. Please look at this. The next class starts after the next number after this, which is 3. All the way to 8 minus 1. 8 minus 1 gives me 7. Then the next class will begin from the next number after 7, which is 8. So 8 all the way to 10 minus 1, which gives me 9. Which gives me 9. Which gives me 9. 8 to 9 like that. So can you be kind enough by doing now the same for the next variable? The next variable, they are calling it who? Variable cost, isn't it? The next variable, they are calling it variable cost. So variable cost, there are three possibilities as well. So we have 200, 250, 300. And then they have given us probabilities. I will come to the two decimal places there. Let's just master this one. So they've given us probabilities. We can see we have 0.1. We can see we have point what here? 6, 0.6. And then lastly, we have 0.3. So then get ahead and give us the cumulative. Give us the cumulative probabilities first. Give us the cumulative probabilities first. The online students, are they able to follow? The online students, are they able to follow? Great. Thank you so much. Great. So then the cumulative probabilities, we have 0.1. So you're accumulating, remember. This gives us 0.7. This gives us 1.0 because we must be consistent with decimal places. You can't just write here one decimal place, one decimal place. And then from then I will keep mute a little bit to see whether there is somebody who will give us random number ranges. Let me keep silent a little bit. Let me keep silent a little bit and see whether somebody will be able to give us these random number ranges. Abracadabra. I can see Geoffrey Karani. Thank you so much. And I can see another ninja up there who has been able to get all of them correct. Great. So random number ranges. What do we have over here for our random number ranges? For our random number ranges, ladies and gentlemen, the first one will be 0, isn't it? All the way to 1 minus 1. 1 minus 1 gives me what there? 0. Or simply 0. 0. From there now we got the next number. The next number after 0, the upper limit will be what here, somebody? 1. All the way to 7 minus 1, which gives me 6. Then 7 to what here, somebody? To 9. After that, ladies and gentlemen, go ahead and give me the sales volume. Go ahead and give me the sales volume. So sales volume, we have here 40,000. We have 50,000. We have 60,000. Then we have, in this case here, probabilities. So probabilities, we have here 0.4, 0.5, 0. I will keep quiet and wait to hear from you. I will keep quiet and wait to hear from you, great students of mine. Because that one can only be obtained by yourselves. That one can only be obtained by yourselves. Already Mildred has been able to get it. Cumulatives first, Esther, thank you very much. So first, Mwalimu do the cumulative, right? So cumulative is 0.4, 0.9, and then 1.0, isn't it? 1.0. And then now out of this, I can get what we are calling random number ranges. And remember this Rn that I'm talking about, Rn stands for random what here? Random number. Rn stands for random number. So then this one will be 0 to what here, somebody? 3, 4 to 8, and then lastly, 9 to 9, or just 9, isn't it? Just 9. So from there, go ahead and give us what we call a simulation worksheet. Go ahead and give us a simulation worksheet. Give us a simulation worksheet. Give us a simulation worksheet. So simulation worksheet, what do we have? We have here run number. And for each run number, how many times have they told us to run, by the way? Have they given us how many times do they want us to run? These ninjas want us to run how many times? They haven't told us, So we must exhaust all the numbers. We must exhaust all the numbers. No problem. So I can write 1, 2, 3, 4, 5 first. And remember, for each run, we must estimate each of these 3 variables. To estimate them, We use random numbers given by the examiner. So I'll pick the first random number given by the examiner to help me predict the price. Then I pick another random number given by the examiner to help me predict variable cost. Then I'll pick another random number given by the examiner to help me predict the volume. Now, please listen before you continue, because I would want to give you time to do this. Please listen. Please listen. When you look at this question, indeed, they have given us the random numbers, for example, for selling price. For selling price, you can see a table there after number 3. A table there after number 3. For selling price, they have given me 8061. Yeah. Then we have 3. Then we have 5139. 5139, 1. So this is number 6, number 7, number 8, number 9, number 10. Now you can write yours. Remember, those ones are for selling price. This examiner never mixed up things. He gave us random numbers for selling price. He gave us random numbers for the selling price. He gave us random numbers for the selling price. Now, ladies and gentlemen, yeah, so we got the next one. You can see random numbers for variable cost. So random numbers, number 3. The following random numbers are provided. Number 3, for variable cost, we have 043, 043, 043, 467, 467, 467, 285, 285, 285, and then 9 lastly. And then volume. Volume, what do we have there? Random numbers, sales volume. I can see 639, 639, 409, 409. And then, ladies and gentlemen, we have here 7685, 7685. No, yeah, correct. Now, I would want to leave you doing the whole thing, and that's why I want you to give me your eyes. Myself, I would want to simulate run 1. Please be keen here. I want to simulate just run 1. So run 1, I can see price, the estimating factor is 8. So if in this case here random number is 8 for price, where is 8? 8 is here. So the price will be how much? Will be 500. Because you see they have given me the random number for price. It is 8. So 8 in terms of price, 8 is here. It corresponds to 500. We got the next random number there, still under run 1. I can see random number for variable cost is 0. So where is 0 here? Variable cost will be how much? 200. How about volume if the random number will be 6? If the random number will be 6, volume will be 50,000. Yeah. So then remember, if it is CVP, we are simulating profit, which is price minus variable cost minus fixed cost, like that. We are simulating profits. If it is CVP simulation, we are simulating profits. So like now for the first run, I can see the price is how much? 500. Why we are not together? How about variable cost for the first run? Are you able to see the quantity? 50,000, isn't it? Has the examiner given us the fixed cost? Amesema fixed cost mahali popote? Do we have fixed cost anywhere? Yes, from the very beginning there. They have told us that the fixed cost is what here? 5 million. Minus 5 million. Minus 5 million. So I'm giving you time now. You finish up everything. We see. Let's finish up everything. We see. What is the first profit? Somebody who has a good calculator. Somebody who has a good calculator. What is the first profit? 10 million? 10 million, I'm told. So in millions, I'm told this is 10. Just try your luck now. You do these runs independently. You do these runs independently. So I would want to see whether there is anybody who will be able to do the second one independently without Mwalimu's interventions. Without Mwalimu's interventions, is there anybody who will be able to do this independently? Is there anybody who will be able to do this independently? Yeah, at times I sympathize with the online students, especially those ones who are in remote areas where internet is a problem. But I suppose that in some way, you guys are able to follow because I'm getting answers from you. And if you're uncomfortable, always keep on asking. Like now here, I'm so sure my handwriting is too small. My handwriting is too small, but I hope. Are you able to follow the online ninjas? Are they able to follow? These online ninjas, are they able to follow what we are doing? Bahati at least is saying, yeah. Then we continue. We continue because if they're not able to follow, yeah, that would have been disastrous. Thank you so much, MB. Let's now try run. Have you done run number 2? Let's see run number 2. How much is the simulated profit? How much is the simulated profit? Catherine already has gotten something there. 10 million as well. Or 1 million. I'm the one who's reading it wrongly. I'm being told that for run number 2, it is 1 million. Is there somebody who is not able to get the 1 million, Bob? We show them how we got it. Anybody who can't get that 1 million, Bob, we show them how we got it. Anybody who is not able to get this 1 million, so we can show them how we got it. I'll be able to show you. I'll be able to show you. Because you see, for run 2, what is the price when the random number is 0? Random number 0, this is 400. At 4 for variable cost, 4 falls here. The variable cost will be 250. The variable cost here will be 250. How about 3 for volume? For volume 3 is here, 40,000. 40,000. This is what they did. They came and said, profit is CMX minus fixed cost. So CM, it is price minus variable, 400 minus 250. And then we come and multiply this with the quantity, volume is quantity, 40,000. And then we subtract our initial cost, which is fixed. That's how we got that 1 million. Let me see what these ninjas are getting for 3, 4, 5, 6, 7, 8, 9, and 10. And one thing that makes me happy is that my students are really trying their best. Like I can see John has already given me 7 million. Have you finished? I really doubt, because you haven't answered what the examiner told you to answer. The examiner wanted average profit. So you get the total, you divide by 10. Did you do that? You see, I'm right. You have not finished. Or the table. All right. So are you able to give me these profits pretty fast, please, for Roman 3? Just for the sake of the students who will be following this later. Number 3, I mean. 7 million, 2.5, 3, 4, 2.5, 2.5, 7.5, 0. So giving us how much? Forget this one, it should be just 1, And remember the first one was 10. So 10, 1. So the total gives us what figure? 40 million. And therefore average will be 40 divided by 10 runs, which gives us 4, So then we'll need a break of how many minutes? 20 is sufficient, yes. 20, isn't it? Or you want more? No, 20 is more than sufficient. So then, my good students, we shall come back at exactly 11:21. It can't be less because I haven't taken my breakfast. 20 minutes will be good for my breakfast. And also, you guys, I know you haven't taken your breakfast, right? Have you taken your breakfast? That early? That means you normally wake up at 5 or something. Thank you. So let's continue a little bit, and then we see how far we shall be able to go. All right, so ladies and gentlemen, here we are. So I would want us to look at this scenario where they have given us, for example, price versus probabilities. So the price could either be 10, 20, 30, probability 0.40, 0.50, 0.10. So could you kindly go ahead and give us? Okay, great. So go ahead and give us the random number ranges. But now remember, here we've got how many decimal places? 2. 2 decimal places. Not a problem at all. The first thing we shall do is to come and give them cumulative what here? Probability, which will be 0.40, 0. What here, somebody? And then we have 1 point, because we must keep the 2 decimal places throughout. Now, after cumulative probabilities, you shall be able to go ahead and give us what we call random number ranges, isn't it? So random number ranges, what do we have? Somebody talk to me. These are how many decimal places? 2 decimal places. So then what do we have here? Somebody 0, 0, 0, yes, 2, 30 or 39. Yeah, it is 0, 0 all the way to 40. 40 minus 1, that gives us 39. After that, we take on the next one will be all the way to what here, somebody? 89, 89, isn't it? Yeah, and then lastly, what do we have here, somebody? All the way to 100 minus 1, which gives us 99. 99. Yeah, so please, you shall never forget this. Never, ever. So we are given, for example, here, X, say 10, 20. Then they give us probabilities. They give us, for example, 0.10 and then 0.90. So cumulative probabilities, 0.10, 1.00. So random number ranges. What do we have here? Somebody 002? Yeah, 10 minus 1 is 9, but I can't write 9 alone. It will be 0 what here? 09. And then we have 10 to what here? Somebody? 10 to 99. So that is really, really important. Ladies and gentlemen, mentioned there, decision making. Yeah. Decision making. And they're going to start with the first one here, dash, continue, stroke discontinue, decisions. Continue, stroke, discontinue, decisions. Decision making, continue, stroke, discontinue, decisions. And I will go straight away to our past papers. And I would want us to look at December 2023, question number 1C. December 2023, December 2023, question number 1, cow. December 2023, question number 1, cow. Once you get it, could you kindly give us a thumbs up? December 2023, question number 1C. December 2023, question number 1C. They have gotten it, right? They have gotten it. December 2023, question number 1C. Question number 1C. Question number 1C. So question number 1C, what are we told there? TL Limited, right? TL Limited sells 3 types of mosquito nets, branded Zero Fly, yeah, Y Fly, and No Fly. I like the names. Product Y Fly is currently generating profits below target net profit of 750,000. The following table shows selected data for the 3 products for the previous years ended 30th June 2023. So you can see the selling price for Zero Fly, Y Fly, No Fly. Contribution margin ratio has been given. Sales demand in units given there. Net profit of 490,000. Additional information, the above data is expected to remain unchanged if Savo Limited continues producing all the 3 products. The sales manager believes that the profits can be increased by dropping Y Fly due to its low contribution margin ratio and they concentrate on the sales of Zero Fly and what here somebody? No Fly. The entire workforce used to produce Y Fly will be utilized in the production of No Fly. The labor mobility is such that 3 units of Y Fly equals 1 unit of No Fly. Or you haven't gotten it, eh? You don't have it, okay? Will you send it to her? The labor mobility is such that 3 units of Y Fly equals 1 unit of No Fly. To increase demand for No Fly, a 10% price reduction will be allowed next year after dropping Y Fly. Unit fixed cost is 6.5. TL Limited prepare statements on marginal costing basis. Yeah. So prepare a comparative statement of profit or loss before and after dropping Y Fly. Advise the management of TL Limited on whether to continue or drop product Y Fly. Y Fly. So then we shall start right away, ladies and gentlemen. So we start here. In this case here, first of all, if we continue with Y Fly, then in this case here, how will our P&L look like? And don't forget we're using marginal costing. Marginal costing is the variable costing. It is the model by which we first of all get contributions. So continue with Y Fly, profit and loss. So the profit and loss here with Y Fly, ladies and gentlemen, what do we have here? Yeah. So we have here Zero Fly, 0, Y, and then we have No. Yeah. So then I would wish you, great student of mine, to give me sales revenue. Sales revenue is price times quantity. Sales revenue is price times quantity. Sales revenue is selling price times quantity. The good thing with management accounting, the moment you start writing like that, already you are getting ticks. Yeah, like we can see in this case here for zero fly, the selling price is 80, right? And the demand is 50,000. 50,000. So what is 80 times 50,000? What is 80 times 50,000? 4 million? Great. So we have here 4 million. How about the sales revenue of Y fly? I love the name. I mean, when we see you flying, we kill you. Y fly? 3 million. 20 times 150,000. The online guys are now not talking at all. 20 times 150,000. 3 million. Thank you so much. How about no fly? 30 times 60,000. 1.8. Huh? 1.8 million. Now from there, we have here the variable costs. So the variable cost, of course, the examiner has not given us the variable cost, but I can get it because I can come here and get what we call the total contribution. So the total contribution, ladies and gentlemen, how do we get this total contribution? It will be CMR times revenue. CMR times revenue. So like now for zero, I can see the CMR for zero is 0.2. 0.2 times its revenue. What is the revenue of zero? 4 million. So 0.2 times 4 million gives me what figure? 800,000, isn't it? So can you kindly give me the total contribution for all the three products? So like you can see, ladies and gentlemen, the CMR for Y-Fly is 10%. So 10% of Y's revenue, 10% of Y's revenue, that will be how much in terms of total contribution? 300,000, right? So this is 300,000. And then lastly, we have, is that 60%? Kwani ni bangi? Your profit itakuwa juu sana, lakini no problem. The examiner ametuambia 60% of 1.8 million. 20? 1080, like that. 1080,000. Now, can you kindly then give me the variable cost? Because the examiner has told us we use marginal costing, we must get variable costs. We must get variable cost. So the variable cost here will be 4 million minus 800. 3.2, isn't it? 3.2 million. So that when you subtract this minus this will give you 800. Yeah, 3 million minus 300,000 gives me 2.7 million as variable costs. And then we have 1,800 minus 1080. 720. 720,000. Thank you very much. Thank you very much. The other way that a good student would have used to get the same answers is this model, method 2. Method 2. A good student should have known that we have what we call VCR. That VCR plus CMR will always be equal to who? Will always be equal to 1. VCR plus CMR will always be equal to 1, where VCR is variable cost ratio. 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 Is variable cost ratio. Now we start with the product 0. Have you written somewhere there that VCR is variable cost ratio? This is very, very important. So we start with 0. So 0, they have given me CMR of 0. What here, somebody? 2. Then what do you think will be the VCR given this relationship? 0.8. Because it will be 1 minus CMR. It will be 1 minus 0.2. Which gives me what here, somebody? 0.8. Is that okay? Yeah, please don't write this here. We haven't finished this statement. So therefore, the total variable cost will be VCR times revenue. So then VCR is 0.8. Revenue of 0. Revenue of 0, you guys had given me a figure of what here, somebody? 4 million. Revenue of 0 is 4 million, which will end up giving us the 3 point, what here, somebody? The 3.2 million. 3.2 million. So it's you now to decide whether to use this method where you get total contribution and then you subtract backwards, you get variable cost, or you use that formula. I mean, the choice is yours. My objective is to give you many methods, and then you'll be spoiled for choices. So up to here, we together? Are these guys able to follow? Yeah. So once we get total contribution, then go ahead and give me fixed costs. So come and say here less fixed costs. Less fixed costs. Less fixed costs. Less fixed costs. So ladies and gentlemen, the examiner again, unfortunately, you get some AMA questions. I've got a few issues here and there. This question was adopted from ACCA. This note number 4, it is supposed to be specific unit cost. Specific unit fixed cost. So it's supposed to have the name specific. And I'll explain why. I'll explain why. The specific fixed cost there is 6.5 per unit. 6.5 per unit. So not a problem. So give me the fixed cost for 0. For 0, it will be 6.5. Do we know how many units of 0 are being produced? How much? 50,000. 50,000. So that will be able to give us the fixed cost for each unit. 25. 325,000. 10. 975,000. 3. 90,000. So in this case, you are able to give us the profit, which will be, you see, it's a profit equals total contribution minus fixed cost. Minus fixed cost. So 800,000 minus this. I hope everybody is able to see what we did to get this fixed cost of Y of 975. Because we know for Y, the fixed cost is 6.5 times the Y units. Y units, you can see Y units are 150,000. That's what we did to get this figure of 975 fixed cost. You see, fixed cost has been given there for each unit. Fixed cost for each unit is 6.5 times number of units. So if it is 0, it is 6.5. We know that 0, they produced 50,000. Yeah, like that. So then they're able now to give us the profits. Now they're able to give us the profits. So profit, it is total contribution minus fixed cost. I hope Marceline, you have been able to pick up 475, 475,000. Yeah, 300 minus 975,000. A loss, of what here, somebody? 675. That is why they want to discontinue it. This is why they want to discontinue it. Yeah, and then you can see no fly. 690, 690,000, like that. So then what is the total profit to the farm? Sorry, total profit to the farm. Total profit to the farm. You add the 3. So we have this plus this plus this. 490,000, 490,000. So I would want you, great students of mine, to give me, you give me, yeah, that's okay. Yeah, that's pretty good. That is, if we decide to continue, we shall be able to realize that 490,000. Now, what if, ladies and gentlemen, in this case here, we decide to do what? To discontinue? Discontinue Y. How will our P and L look like? So discontinue Y. So discontinue Y.
So discontinue Y. Y fly. So then how will our P and L look like? Let me give you a minute. You try to think through this. If we were to discontinue Y, how will our P and L look like? Just think through it. Think through it. You guys are great thought leaders. So of course our P and L now will only have two columns, right? Which column and which column? Zero and no. Sini kweli? Yeah. But you see now here there is a catchword there. You must be able to calculate the new number of units of no which will be produced. Because I've been told the moment you discontinue Y, that particular resource which was being used to create Y, all of it will be transferred to no. Check note number 3. The entire workforce used to produce Y fly will be utilized in the production of no fly. The labor mobility is such that 3 units of Y fly equals 1 unit of no fly. Yeah, great. So I'll come here and do my working here. So we are told here 3 units of Y will be equal to 1 unit of what here, somebody? Of no. So then how many units of Y shall we stop producing immediately? Units of Y we shall stop producing immediately? 150,000, isn't it? So then this 150,000 units of Y will end up giving us then how many extra units of no? So it will be 150,000 if I cross multiply times 1 divided by 3, which gives me 50,000 extra units. Extra units. 50,000 extra units. Extra units of no. And therefore, the total quantity, total sales volume of no, it will be equal to this extra 50,000 plus the very old. Plus the very old. Za no fly zilikuwa ngapi? No fly zilikuwa ngapi? Zilikuwa 60,000, isn't it? Za no fly zilikuwa 60,000. So it means, my good students, that for no fly, we shall be able to produce how many units in total? 110,000. Because initially, before we thought of moving our resources to no fly, we were producing 60,000. But now we are getting some resources new from another department, yeah, that we are closing, yeah, which will be able to enable us produce an extra unit of no fly of 50,000, so 110,000. So come here, give me sales revenue. Yeah, so remember it is price times quantity. We start with 0. 0, are you able to see the selling price of 0? Are you able to see the selling price of 0? 80. Wait, I'm alone. I'm alone. So 80 times quantity. Remember, 0's quantity is not being affected. 0's quantity is not being affected. 0's quantity is how many units? 50,000, isn't it? Wait, online, tuko pamoja kweli. 0's quantity is not being affected. 50,000. This is what you had originally given me as what here, somebody? As 4 million. Then tuende kwa no fly. No fly. Can somebody give me the price of no fly? Price of no fly, 30 wongo. Yes, yes. But for us to be able to sell now this increased quantity, we have to reduce the selling price of no fly by 10%. So the new price, I can come and write in my workings. So the new price will be 30 times 90%. Knock away 10%. Knock away 10%. So 90, isn't it? 90%. So then, please, where am I getting that information from? From note 2. Note 3, actually. The last line. To increase demand for no-fly, a 10% price reduction will be allowed next year after dropping Y-fly, which gives me 27. 27. So it means that this will be 80. No, 27 times which quantity of no-fly? 110. Sinikweli, which will end up giving us what figure? 29? 2970,000. Great. Then leave some space for variable costs. And then we shall be able to get our contribution. We shall be able to get our contribution. Our contribution. So contribution, I can't subtract because I don't have variable cost. So I have to use the percentage. So fortunately, ladies and gentlemen, we know the contribution margin ratio for 0. 20%, isn't it? So it will be 20% of revenue. Yeah, so that is 0. So it will be 20% of 4 million, which will end up giving us what figure? 8 million, right? 800, 800,000. So please subtract this. 200, That 200, like that. Go ahead and give me the contribution of no. No, please read the contribution margin ratio of no fly. Contribution margin ratio of no fly is what percentage? Is 60%. So 60% over how much here, somebody? 2970. Yeah. So what I know with advanced management accounting, it may look crazy, but so long as you're able to write things here and there, plus now the theories, you'll always survive, always. So a ninja is telling me that Mwalimu, this one will be 17 what? 1782. So then to get variable cost, please take this minus this. This minus this, shall be able to get variable cost. So take this minus this, we shall be able to get variable cost. So I'm being told 1188,000. Do we stop there? No. We still have fixed cost to knock out of this. We still have fixed cost to knock out of this. So come here and subtract our fixed cost. Come here and subtract our fixed cost. So remember, we start with 0. 0, it is 6.5 times the number of units of 0, which are 50,000. So 6.5 times 50,000. Online guys, are they answering? 325,000? 325,000. Yeah. And then we have in this case here, no. So no, it will be 6.5 times 110,000, yes. Times 110,000, yes. So 6.5 times 110,000, which will end up giving us some great Rina 715. 715,000. So you subtract there, So then you'll be able to get what we call net profit or just profit. Profit. I'll wait to hear from you. 3.2 minus this 325. What shall we end up getting? Silva is saying variable cost is 3 point. Variable cost is 3.2. Ama contribution will go 3.2. 3.2 is? Oh, so I changed. I interchanged, right? So this is supposed to be, thank you for that. This is supposed to be 800,000. This is supposed to, thank you very much for the correction, because we are doing these videos here for future generations. We don't want future generations that we are recording and they come and say, mzee alikuwa mjinga sana. So now we believe everything is okay. Now we believe everything is okay. Now, after that, ladies and gentlemen, you should be able to give me the profit, isn't it? You should be able to give me the profit. 475,000. Thank you so much. 67,000. Thank you so much. So what is the total profit? Please add the two. You take this plus this, give me a figure. 1542. Mbesha ni mzuri. So which one in this case is better for us? We drop because profit here will be high, isn't it? So this profit here is optimal, is a higher, and therefore we shall discontinue. Why? This profit is bigger, it's optimal, it's better, and therefore we shall discontinue. Why? We shall discontinue. Why? So I can see we have a few minutes to 12. I can't start doing make or buy decisions now. I would want to leave you, and I'm not giving you any homework, because my way of teaching is to always encourage you guys to get ahead and do what here, revise what you have done. Try to look at what we have done. Otherwise, I want to take this opportunity to wish you a lovely weekend. And of course, in this case, if there is any ninja CPA AMA student who would want to join us, RCM, for your classes or classes of CPA, don't hesitate calling us. That is our number, 0793 555 000. And of course, it's my hope that you guys have gotten something out of this. You are not going to the weekend empty-handed, right? Thank you. Bye. Great.